Hello, everyone. I'm your host this afternoon, morning, or evening, depending on where in the world you are joining us to this virtual event, Powering Forward Crude Awakening, brought to you by Bloomberg Live. Today, we're going to be talking about the oil markets, which were absolutely rocked this year due to the COVID-19 pandemic. This made governments put restrictions and lockdowns on cities. People were forced to stay at home. And on top of that, we had flights around the world just completely grounded. The whole world almost to an absolute halt. At the same time, we had a supply situation unfolding. Russia and Saudi Arabia, just before really the pandemic took hold, at least in the West, they were on an all-out price war. So we had a twin shock on the demand side and on the supply side. And this really all culminated in April this year when we saw oil prices trade below zero into negative territory. The first time in history, an absolutely historic day. Traders scrambling to find storage facilities just capitulated on the price for WTI. Now we have a little bit of stabilization. We have these OPEC plus cuts, an historic deal. Also, other producers not part of the cartel and friends also deciding as well to ratchet back production. But what did this moment in the oil market mean for the industry going forward? Today, we're going to talk to leaders on the front line, a trader that's seeing what's going on in the physical market, on the policy side, and as well as an industry leader from the shale patch, how this crisis will shape the longer-term trends and the changes of the industry. But this is a virtual briefing brought to you by Bloomberg Live and Bloomberg Television. We are all new to a virtual event, so please bear with us. If you experience any sort of technical difficulties, the first thing I would say is refresh your browser. Also, it's an interactive event, so please, there's a Q&A box you should be seeing on your screen. Type in your question there, your first name, your city if you want to shout out, and click submit. And we'll make sure we try to get as many of these questions we can to this all-star panelist. And we're also going to be conducting audience polls, especially if you're at home. I want to make sure you're paying attention. Fill them out. Let us know your thoughts. And also, we'll be asking those questions to our panelists as well. And engage with us on Twitter, not just hashtag OOTT for the oil world, but also hashtag powering forward. Okay, let's get started. We're actually going to start with a conversation I had earlier. She couldn't join us live, but this was my conversation with Norway's energy minister, Tina Bru. This is what I wanted to talk to her about. They actually decided to cut production as well, historic for Norway, and I wanted to know how deep and how long they are going to keep those cuts. Take a listen.
Norway's energy minister, Tina Bru, thank you so much for joining me from Oslo. I want to start with what happened a few weeks ago. Historic cuts Norway announced alongside what we saw OPEC Plus do to stabilize the market. We've seen some of the Gulf exporters cut even deeper, like Saudi Arabia, Kuwait, UAE, and now the group is talking about even extending those cuts further. Is this something you think Norway would do? Would Norway cut even deeper on the cuts they've already announced?
Well, Norway has gone through with production cuts at certain times before. Each single time it has been because of an extraordinary situation going on globally. I think the last time we cut production was in 2002 following the September 11 attacks. And each time we've done so, it's been based on an independent decision in regard to our own resource management and the outlook for the Norwegian economy. So the cuts that we made this time was because of the extraordinary situation we're seeing because of the pandemic. It's a contribution to try to stabilize the market a little bit quicker than what would have happened if we did not go through with cuts, but it was a prerequisite that the bigger producers did the same. So our cuts came after the OPEC announcements. We are making a substantial cut now. When we come to December at the end of this year, we will be producing 300,000 barrels less per day than what was initially planned. So at the moment, I feel this is a good contribution. I think we're seeing already clear signs in the market that it's moving towards stabilization a little bit quicker than the worst fears. So we will end regulation by the end of the year, but at this time, this is the cuts that we are ready to go through with.
So at the moment, there's no talk of extending into 2021?
No, we're not discussing that politically or in the department ministries at this time. Right now, the situation is that we will see these cuts through to the end of the year, but then again, we can end the regulation quicker if we see that's possible. But on the onset, the plan is to keep these production cuts in place until the end of the year.
You said you see some signs of stabilization, and we are seeing that with the price of oil as well. But we still have more than 1 billion barrels in terms of inventories. How long do you think we will see like proper supply and demand stabilization in the market?
Well, I think it's difficult to say, and I'm sure there are oil and gas market analysts that can probably answer that question a lot better than me. But I think it's a good sign that we're now seeing the oil price going a little bit up. I think some of the worst fears that we had just a month ago about seeing storage globally go to max capacity is maybe something we're not as worried about right now. But like you point out, there is still a huge surplus. The demand is not back to where it was before. But I think as more countries eventually start opening a little bit more up, and we're seeing some of the pandemic receding in some countries across the world, the hope is, of course, that people will start flying again, driving their cars. The economy will bounce back, even though we know it's going to take a while. And this will, of course, also affect the demand side in the oil market picture.
I know Oslo is starting to open up, or Norway in general. Are you seeing more demand pickup within Norway?
Well, we are seeing like one really example that you can see just by moving around is that people are starting to fly again. I think a lot of things have changed because of this pandemic. I think just having digital meetings on webcams, etc., is something that we're probably going to keep doing more, even though things come back to normal. So I think it's too early to say now exactly how this will play out, but we are seeing more people starting to move around, but we still have a really high focus on keeping the virus at bay. So we still have many measures in place to ensure that we have good hygiene, that we don't sit too close together, to make sure it doesn't shoot back up, because it is, of course, a major health issue that we take very seriously.
During the previous downturn in 2014, OPEC had invited Norway to come to the meeting. Have they done that this time around? Is this something that you'd be interested in doing?
Well, we were invited as an observer on the meeting that they had before they came to the conclusion of cutting production. We're not part of this cooperation. We're not a part of OPEC. I did not myself attend, but we were represented on our officials here in the ministry. So I mean, we're not part of that group. Any production cuts that we make will be based on independent decisions, based on what is good for our economy and our resource management.
Have they invited you? I'm curious, to the June meeting.
Not that I know, no.
I want to talk about what's going on in Norway. The opposition lawmakers, the majority in parliament, there's possibly going to be this tax change about the government proposed for oil companies to make it even more generous. My question to you is, what does all of this mean in terms of tax changes to the corporations, about Norway's outline to more greener industries? Like, what does that mean for the future in terms of moving towards renewables?
Well, that's a really big question, and I mean, it would take a long time to answer all of that, but I think the baseline of this discussion is based on the fact that this situation is really extraordinary. We're seeing a drastic drop in activity on our continental shelf. We have a lot of supply industry that is totally dependent on projects being lifted on the continental shelf. And I don't think we're going to manage to have a good green transition that creates jobs, creates value, helps to build our economy if we lose all those businesses that now are a really big part of that change. And a lot of that business is in the oil and gas industry. During the last downfall in the oil price, a lot of these businesses actually started looking towards other markets and were building their portfolios so that they could also deliver into, for example, renewables. So I really do believe that we need to make sure we don't lose all these businesses right now because of this really, really special situation. And that's also the foundation for why we actually propose to make some temporary adjustments in the tax regime to make sure that we don't have a full stop in all planned new projects on the continental shelf, because it's so essential for businesses and jobs here in Norway.
Yeah, the industry is really struggling. Oil companies having to cut costs, cut jobs. So it sounds like the government, at least temporarily, wants to be even more supportive of the industry. What is the best way to accommodate the industry? How do you secure that employment? How do you secure and support these new projects?
Well, one of the things that they really pointed to when everything happened and everything shut down was that they had problems with liquidity. So a big part of the proposal is actually to make to free up capital so that they can keep planning the projects that they already have planned. And we all know that these projects have a really low break-even price. So there's really no risk, in my opinion, that we risk here moving forward with projects that will not be profitable in the future. Most of them have a break-even price at around $22 for planned projects on the shelf. And that's also important in this context because it's not about pushing forward projects that are not economically viable in the future, but it's about making sure profitable projects continue despite of this really, really extraordinary situation where they are experiencing big problems with liquidity because of the global oil market situation.
I want to ask you about the carbon capture program. Equinor, Shell, Total, they all want to go ahead, but the thing is, they want the government to pay for a lot of it. If this goes through, what is the government willing to finance in terms of this carbon capture project?
Well, we know that we have to contribute with a substantial part, and I think that is not very surprising. I mean, this is a costly technology, but it has been a clear political goal for Norway for many years to lift CCS at big scale. So we've been working really hard on this project for over 6 years, but a really important part of this is actually having industrial partners along with us. So I do see a clear commitment from the industry itself to also be a part on the financing side, which is different than earlier times when we've tried to lift these kinds of projects. But of course, the state has to also step up and be supportive, and we hope to be able to do that. We will be making a decision in the fall with the state budget. But this is it's a big project. It's a lot of money, and we need to make sure that the costs are at a level that can be handled and that it's something that will motivate other countries to follow with CCS, because I mean it's good if we can lift this in Norway, but if we are to create a value chain, if we are to get this technology implemented worldwide, we also have to have other countries following and seeing this as an opportunity. And that's why we have to plan this in a good way so that it doesn't, in the worst case, stand out as something not to be followed, but something that motivates to do the same.
So a decision will come in the fall, but are there any scenarios you're looking at so we have a better idea of exactly how much the state will cover?
Well, there are several. I mean, we don't have the exact how we will split between the industry and the state at this point. That's also commercial negotiations that are going on at this moment, so I can't speak to that. But of course, the state will take the bigger part of this investment. It is a substantial amount, but one of the things that we also have to decide in the fall is if we're going to go for just one capture project or two capture projects, and of course also the transportation and storage part. And the storage part and transportation is really important because that is how you create this value chain. And we're seeing great possibilities on the continental shelf here to be a storage for CO2 that not only Norwegian industry and businesses can use to store their CO2, but something that also European industry can use. And I think that will be a prerequisite if we're going to reach our climate goals. We have to find solutions to how to both capture but also store CO2, or else I think it's going to be really, really hard to reach our goals.
And you don't know yet whether it's going to be one or two.
No, that's also part of the decision. Are we going to have one, two, or none? Basically, I mean that's always, of course, always has to be on the table. But we're really hoping to lift this, of course. But right now, the project is out on quality control externally to check costs, to check if this is possible to go through with, what the market looks like, etc. There are a lot of processes that are going on to make sure that the foundation for our decision is as good as possible when we reach that point in the fall.
Our thanks to Tina Bru, Norway's energy minister, for speaking with me there. She was on that G20 call that IEA's executive director Fatih Birol was also on, and he joins me now from Paris. Fatih, thanks so much for joining us on this virtual event. I hope you're well and safe.
So I am very well and safe. And what about you? Everything is okay with you?
Yes. I'm actually in New York, so things have been a bit interesting, living in now a lockdown and a curfew, but I am safe and healthy. So thank you so much, Fatih. The first question I have for you is actually a question I also want to ask the audience. What should OPEC Plus do at their upcoming meeting? So we have some options for the audience. Turn on the taps. I doubt that's going to happen. Extend the deeper production cuts or start to taper production. Fatih, what do you think they're going to do? There was potential of maybe even having the meeting today. The meeting can come in the next few days, a bit unclear. But when they do finally decide to meet, what do you think they're going to do?
Of course, it is not appropriate for me to tell OPEC do this or do that. But when I look at the numbers, we see a gradual recovery of the oil markets for three reasons. One, demand is slightly better than in the previous months. Number one, demand recovery. Number two, OPEC plus agreement, perhaps not full, but a large extent compliance with it. Number three, not much talked about, but very important, a steep decline in US, Canada, and other countries where the markets are run by the private companies, the oil companies. So gradual recovery, if we don't see demand recovery continues, if we do not see OPEC plus agreement is not fully complied or not extended for some time, this may well be a cold shower on the current gradual recovery of oil markets. So it is the reason I wouldn't say do this, do that, but the current three factors need to continue in the next weeks, months to come, if one wants to see a recovery of global oil markets.
OPEC. Going into this meeting, it seems like Saudi Arabia and Russia are actually on the same side, and they really want to clamp down on the cheaters, most notably Iraq, as well as Nigeria, Kazakhstan. But for a country like Iraq, that is going to be very hard in terms of these production cuts. Is it possible for countries like Iraq and Nigeria to really start to cut production and not cheat?
Now, I cannot again say they should do this or that, but not all producers are in the same category. Some of the producers have much stronger reserves and a political stability, while others are politically and economically much more fragile. And some of them were hit by the pandemic more than the others. You mentioned Iraq. Iraq has a new government, a very promising government, and I hope that they will deal with the problems they have in front of us under very difficult conditions. One of them is, just to give you a number, Annmarie, the 80% of the Iraq's budget, government budget, comes from the oil revenues. And with the current price levels, they are only able to pay the half of the salaries of the government employees. Leave aside the money for the health services, money for education, and others. So therefore, those countries, Iraq, Nigeria, Angola, Algeria, I should say, Algeria is hit twice. One, because of the low oil prices. Second, bulk of the Algerian gas contracts are indexed to oil prices. They are also affected from that. So different countries with different challenges in front of them, and Iraq, Nigeria are definitely at the top of that rather more vulnerable oil producing countries category.
I know you can't comment too specifically, but you obviously outlined a lot of challenges for a lot of these countries, notably Iraq. What does Russia and Saudi Arabia do then? Do they walk away from potentially deeper cuts if they're not going to get the commitment they want to see from Iraq?
I think if the prices and the markets, they do not recover, this will have implication for every oil producer whose economies are very closely linked to oil prices, in other words, oil revenues. Both Russia and Saudi Arabia, if not today, tomorrow, they may have more reserves than the countries we talk about, but they will also have difficulties. Saudi Arabia was instrumental to bring the G20 extraordinary meeting, which International Energy Agency has initiated, and Saudi Arabia show once again their responsible leadership here, brought that extraordinary meeting, as you rightly mentioned. The Norwegian minister was there, in addition to 20 major producers and consumers around the world. And I believe that meeting itself also helped to stabilize the oil markets.
I want to talk about demand, since that has been just incredibly destroyed. We do see China picking up, I think quicker than a lot of other people even expected. But what about the rest of the world? When will we see proper demand pick up in Europe and in the United States?
I think when we look at the world, we see three regions. The activity is now getting close to before COVID levels. China, United States, and some parts of Europe, including Germany, by the way. And if you put all these three regions together, it is about 50%, half of the global oil demand. How they will continue, whether or not we will come to the levels close to before COVID, will be depending on whether there will be a second wave of pandemic, and second, how the economic recovery will look like. But when you say peak, some people say, in fact, there's a growing chorus from some of the NGOs to CEOs of some energy companies that we have seen oil demand peaked forever, about 100 million barrels per day, because of the changes in the lifestyles and the behavioral changes and so on. I don't necessarily agree with that the view. And I believe in the absence of strong government policies, with the rebound of the global economy, in the context of low oil prices, we may well go back to the level we had before COVID, and maybe beyond that. So therefore, the key issue is the pace of the economic recovery and the government policies. And I don't think that teleworking alone, change in the lifestyle alone, will not, they will have an impact, but it will not avoid the oil demand come to the levels before COVID.
Yeah, I've been hearing a lot of like two sides to that story. So Shell CEO, BP CEO Bernard Looney, they're talking about the fact that maybe, as you mentioned, 2019 was the last time we'll ever use 100 million barrels of oil a day. But there are also other people who say that due to the pandemic, more people are going to get into cars. You're going to see people move out of cities. So maybe there'll be more oil use. But also Fitch Solutions was saying that global jet fuel demand may not return to pre-crisis levels until 2026. Now, you say we're going to see pre-crisis levels, but Fatih, when? When will we see 100 or more million barrels a day be used again?
Okay. First of all, when and if we go back. So I don't say that we will go back, because the key issue here is the government policies. If governments give it through their recovery packages, give us support to improving efficiency in the transportation sector, putting more emphasis on electric cars, for example, incentives, this may be a reason we may not go back to the peak oil demand we had before. The second is the economic recovery. If we do not see a strong economic recovery, this may also delay the going back to peak. But in the absence of government policies, strong government policies to reduce the oil demand, plus a rebound of the economy, we may well see the going back to peak in a few years of time. And do not forget, aviation numbers are important here. Unfortunately, lots of discussions are taking place without looking at the numbers. Aviation is only responsible about 7% of the global oil consumption. 93% comes from somewhere else. Cars, you mentioned growing demand on cars. It is one of the biggest one. And the second biggest contributor to global oil consumption is the petrochemical sector, which even in the pandemic times didn't go down. So petrochemical plus cars make close to 50%. Both of them are strong drivers of oil demand growth. Whereas I agree, jet fuel will take some time, a significant time, but let's do not forget its contribution to global oil consumption is only 7%.
I want to bring in one of a viewer question for you. He's from Lima, Peru, Jorge. Thanks so much for writing this in. And this kind of goes into what you're saying, Fatih, about moving forward, the energy transition. He says, has the possibility of a carbon tax on oil increased?
Carbon tax? And? I didn't get the question.
Governments take advantage of low prices, increase taxes, and consumers will not see an increase on the price of oil at the gas stations.
So, two things here. It's a very good question. But to implement a carbon tax globally today is extremely difficult for two reasons. One, we have a carbon price, for example, in Europe and in some parts of the world, but to introduce a carbon price today, especially in emerging world, where the oil demand is coming from, biggest part is, I don't believe it is realistic. Having said that, from an economic efficiency point of view, this will be the best option. But, Annmarie, this is very important. Leave aside the tax. Today, there is about 200 billion US dollar subsidies of fossil fuel consumption in the world. So many countries, our governments are giving subsidies to use oil or whatever as other fossil fuels much cheaper than what they really cost to them for different reasons. It creates burden on the shoulders of the governments for their budgets. Second, it is not a good news for the environment. And third, it is a bad news for energy efficiency. So therefore, it will be better to phase out, minimize those fossil fuel subsidies, which are distorting the markets and as such hindering the clean energy transitions, which is a big problem for many governments because those subsidies goes from the government budget directly. So carbon tax is a very good idea from a theoretic point of view, but much difficult to implement nowadays, especially coming from emerging countries. But with the low prices, oil prices today, may give an opportunity to phase out the subsidies, getting rid of this burden from the government budget and accelerate the clean energy transitions.
Yeah, really interesting question. We only have a few moments left. I wanted to ask you about, we had this with the OPEC deal. The U.S. president, of course, Donald Trump, was actually calling for higher oil prices, something you would rarely see out of the U.S. But of course, now the U.S. oil industry is thousands of producers and millions of jobs. And we're going to be speaking to a shale CEO, Scott Sheffield, next. I want to ask you, do you think shale will fully recover from this twin shock, epic price collapse we've seen in the oil market?
So what we have done is that we have, just last week, we look at the global energy investment picture. How much, in which sector we are seeing a decline in investment. There is a big decline in the global energy investment across the oil, gas, coal, renewables, and everywhere. But the biggest hit is on shale. Shale investment this year, we expect to decline 50% compared to last year. But I think it is far too early to write the obituary of shale, because with the increasing prices, when they come to $40, $45, we may well see shale oil to recover because technology is there, still technology is there, know-how is there, and also the geology is there. So as a result of that, if we see demand to recover, therefore prices comes to $40-45, we may well see a gradual coming back of shale, but it will take a long time to come to the levels that we have seen before COVID. But once again, it is far too early to write the obituary of shale oil in the United States.
And maybe it's too early to write the obituary for OPEC+. Fatih Birol, thank you so much for joining us, the IEA Executive Director from Paris. We really appreciate your time today.
Thank you.
For the audience, we're going to do another poll before we get to our next panel. How high will crude prices go this year? Maybe we're seeing the highs now. Do you think we'll see 40s or 50s? Let us know your thoughts. We're really interested in that. And I'm excited about our next panel. This is really the key players on the industry side. As I mentioned just there with Fatih talking about shale, we have the Pioneer CEO, Scott Sheffield. Thank you so much for joining us. It's early morning for him. And then in Switzerland, we have Ben Luckock, the Trafigura co-head of oil training. So I quickly want to just
Annmarie,
pick up with you, Scott. Hi. Okay, do you both hear me?
Yes, I can.
Oh, great. Thank you so much both for doing this. So, Scott, I want to quickly pick up on Fatih's point there, not writing the obituary just yet for shale. Where do you see shale going after this? I mean, we've already seen bankruptcies. We've already seen cost cuts and job losses. What partially starting to bring some production back? You know, what is the outlook you have on shale?
Yes, thanks, Annmarie. It's great to be on your show. As you know, U.S. production peaked in February, close to 13 million barrels a day. Most producers have announced plans. As Fatih said, we're down about 50% plus in CapEx budgets. Most people are trying to keep production flat compared to 19 levels. So we're down about 2 million barrels a day right now, the best estimates. The problem is that about a million and a half of that is coming back. Several producers have announced in the last 48 hours they're bringing their oil back. They were shut in for the month of May, but was coming back on the market in June and July. So I estimate about a million coming back in June and July. Now, what's going to happen due to a couple other key events? One, about 90% of the independents are way over levered. And so as oil prices coming back, they're going to have to delever the balance sheet. Secondly, shareholders have demanded more returns back into their pockets. They are not focused on growth anymore. And so as oil prices increase, you're not going to get back to the levels we saw over the last 2 years. So I still believe that U.S. production will end up at the end of 2021 around 11 million barrels a day, which is about where we are now. We're going to see an increase with this curtailment. And then it's going to stay flat, in my opinion, for several years at around 10.5 to 11 million barrels a day.
And what about Pioneer? When are you going to bring back some shut-in production and how much?
Yes, Pioneer only cut 7,000 barrels a day of our total oil production of around 225,000. We produce around 375,000 barrels of oil equivalent per day. We export. Historically, we've been exporting almost all of our crude. About half of it's been placed in the last couple months into the domestic market, but exports are starting to come back. But there is a narrowing of WTI and Brent. And so we might not be able to export. And also, I'm concerned, but it'll be good to hear from Ben in regard to the tankers. There's a lot of storage of oil off the Gulf Coast and around the world. We are no longer in contango. And so it doesn't help for oil to be stored. So we got all that oil coming back on the market, too, at the same time, right before an OPEC meeting. And then we have several producers increasing production over the next 30 days. So it'd be interesting to see his comments also. How is it going to affect the price of oil? So.
Ben, do you want to pick up there what Scott's saying, where we are in the
Sure.
curve?
Thank you, Scott. Thank you, Annmarie, for having me as well. I think Scott's hit the nail on the head. We had a huge amount of oil that was headed for floating storage when we had deep contango a number of weeks ago. The market has moved substantially since then, both on a flat price basis and on a structure basis. We have shallow contango on WTI and a little bit similar on Brent as well. So a lot of this oil isn't going to make it to the boat. And if it did make it to the boat, a lot of it's coming off. We've seen really strong demand, not just for US oil, but for oil generally from China in the last few weeks. They've bought a lot, and I now think they've got a little bit of stress on their system to bring the oil into the country. So that has slowed down a little bit. But I think a lot less oil is going to get stored on boats than we were planning 6 weeks ago. But it's actually a bit of a concern, really, because we're now back towards $40 on Brent. I think I agree with Scott that you're seeing people bring back some production, and it's coming back at a time when we should probably we're now back towards $40 on Brent. I think I agree with Scott that you're seeing people bring back some production, and it's coming back at a time when we should probably we're now back towards $40 on Brent.
Sorry, I think I had you on loop back. I didn't realize you finished. Ben, I want to also ask you about demand, because you were one of the first people to really come out during the lockdown before we saw prices go negative to say we are in serious demand destruction. I think at one point you said as high as we're losing 30 million barrels a day, which is huge. China has picked up, but what about the rest of the world? Will we see this replicated outside of Asia?
Not in a hurry. I think the 30 million number that we quoted was largely accurate. It's not easy to have perfect statistics on this. I would say China is largely back. They've done a very good job of getting back. Europe, we're starting to see, us come out of the lockdowns here in this part of the world a little bit quicker. But demand is probably only halfway back from where it was in very broad numbers. So we are concerned about how sticky this last half is, particularly in the Western world. And we're worried that with the incremental price increase that we've seen and with poor refining margins, what exactly is going to happen going forward? Because we're not out of the woods yet with coronavirus.
But if 2019 was 100%, what would you put like the next 9 to 12 months?
I think it's very hard to get back to. I think it's incredibly difficult to get back to 100% within that time frame. I think we've done some damage to the industry. Mr. Birol mentioned aviation. Yes, it's a small part, but it's an important part of this industry. And I think our lives have all changed. I haven't flown in 3 months. I don't plan to fly in the next month or two. Yes, I will drive more. I do agree with this, but people's lives have changed, and we are concerned that it will take a long time to get back to the demand levels that we've seen before. This is not unprecedented in terms of regrowing after a setback for demand. After 9/11 was a good example where we took years to get back for gasoline demand in the US, and so was the financial crisis around a decade ago. So we do know that it takes time to get back. But I think this is the problem that the market has at the moment. And I really don't believe that we need a substantially higher flat price than we have here. We've done well to get back to this point through the coordination of the industry, but I don't think we need to trade substantially higher than here in the short and medium term.
That sounds pretty bearish. Scott, I mean, where do you see the U.S. leveling off?
Yes, as I said, I believe with Fatih and also with Ben on the demand, first of all, I don't see demand coming back until 2022, 23. We got to get the airline industry back, and we got to get vaccines for COVID-19. But, I see U.S. is definitely going to be down 10 to 15%. But if you want to think longer term, I think we'll be flat production around 10.5 to 11 million barrels a day for the next several years is my prediction. Based on producers delevering, there's just a few producers like Pioneer that's going to be able to grow somewhat, but most producers will be delevering. And so that means U.S. shale was representing about 8 to 9 million barrels a day of the U.S. 13. And so U.S. shale will be down roughly about 2 million barrels a day long term.
The EOG CEO recently said shale will never be the same again. Everyone's talking about peak oil production in general, but are we past peak shale production in the United States?
Yes, the rocks are, as Fatih said, the rocks are still there. The geology is still there. We'll have bankruptcies, but the bankruptcies will have new shareholders. So the rocks are not going to leave or move. I think the big push is what shareholders have pushed for in regard to instead of companies focused on big growth, they're focused on returns. And so there's going to be dividends and variable dividends being thrown out by the producers. I don't see the independents coming back until we see at least $45 WTI. So I'm starting to hearing some frac fleets coming back now. People have a lot of DUCs, that's drilled uncompleted wells in the U.S. Those will come back first, but I don't see people picking up rigs until early to mid next year, assuming WTI is around somewhere in that $40 to $45 range.
And what about consolidation in the shale world? Do you expect a wave of that to happen?
No, I've commented, Annmarie, several times about consolidation. What's preventing it is the fact that too many companies are over levered. Even the majors are struggling with their dividends. They're having to borrow to pay dividends. Now we saw Shell cut their dividend already significantly. Many companies have cut their dividends, but consolidation will not occur until companies delever the balance sheet. Or if they go into bankruptcy, there could be opportunities for companies to acquire companies once they go into bankruptcy. But I do not see a lot of consolidation. It should happen. I hope it happens at some point in time, but I just don't see it at this point in time.
I want to move on to OPEC because they're going to have a meeting at some point very soon. It's supposed to be next week. There was talks of moving it actually to today. Ben, what are you expecting from this group? I know these decisions move the price a lot. As a trader, you have to be prepared. I mean, what if you were going into this meeting, where would you be on the price?
Yeah, I mean, these meetings do move price. Sometimes it's actually a little unhelpful. I think one of the worst price movements was the OPEC meeting during the crisis when we managed to have prices rally when really prices needed to come off to disincentivize production of oil we didn't need. We're in a very different world now with OPEC where I think they're acting rationally, sensibly. We found a much calmer market price set here. I know there's some problems with particularly Iraq, you mentioned earlier, in terms of compliance. My guess is they'll iron this out and they'll work on this on a month-by-month basis. They came out last time and said this is a long-term plan well into next year. And that's exactly right. This is going to take many, many months to sort out this glut of oil that we still have on the market. And I think they're doing a good job and acting very sensibly in the medium-term interest of the producing community. I just think we're in a much more stable market now. This kind of price level, Scott mentioned 40, 45 for WTI to bring back production, which we don't need, means we shouldn't go too much higher than here. But equally, I don't think we go much lower. So the past 3 months of huge volatility for me is behind us. OPEC's doing a reasonable job to serve their own interests and serve the producing community's interests. So I think we're just going to extend, and we shouldn't think too much about what they do more than about a month ahead, because they are quite reactive these days, and they've shown they're prepared to have almost instantaneous meetings when they're required. Because we can do meetings like this now. We don't even have to get together. We can all get onto a webcam and have a meeting.
Yeah, that's right. Exactly. I mean, I'm always changing flights and hotel bookings to follow the cartel around the world. This has now just been basically canceling any plans you might have and following them around every WhatsApp chat or Signal, etc. One thing I find interesting, though, about going into this meeting is a little bit like the politics of it. Usually Russia and Saudi are the ones that are on opposite ends. And right now we see them taking a hard line on the cheaters. But we do know that this is painful for Russia. I mean, they've cut sort of-ish, but they have had compliance challenges in the past. I know you have teams literally all over the world. When do you think Russia is going to be desperate to start easing off these cuts?
I think they're okay at this sort of price level. I mean, I don't think anybody was okay when Brent was at $16, $17, and $18, and quite obviously a negative number on TI was to a level of absurdity on the oil price. We don't see a lot of stress from Russia at the moment. We're a customer of theirs, and we sell a lot of oil around the world of Russian origin. they don't seem stressed at $40 oil. And I think that's why you're seeing a really very sensible OPEC strategy at the moment, because the crisis is over in terms of oil prices. There's a level of stability. I think there's a recognition there's almost nothing you can do to get the oil price $50+ at the moment. The world doesn't need the oil, and it doesn't need it at that price set. So there's a level of calmness from the OPEC producers that we talk to, which is pretty much all of them, that things will not change that much, and they're staying the course and they're acting sensibly. The fact that they're debating a relatively small issue around compliance so strongly tells you that they're a bit more relaxed about the whole thing. And there's a level of calmness. So we don't see much stress out of Russia, or really for most of the producers.
We have an audience question for you, Ben. It comes from Lagos, from Olufemi. He wants to know, is there any mitigation in place to prevent future shocks like this, particularly preventing a contango, which we saw super contango the past few months?
I don't know why you'd want to prevent the market from acting rationally, because when I reflect on the last 3 months, I think you had a market that, for all of the noise, did what it needed to do to solve a problem. We were producing too much oil that the world wasn't consuming as everybody got locked down at home. We needed a solution for it. That solution was to lower the price, the outright price, such that producers would not, in fact, pull it out of the ground, or provide contango so that people like us could afford to store it not only in a tank but on a vessel. So the market, for all the noise, fixed the problem. We got low prices when we needed. We got contango when we needed to put it onto the boats. And as Scott said earlier, the contango has come back out of it. So now we're not putting it on the boats because we don't need to. So I don't know why we would want to stop the market operating efficiently, which I really believe, looking back, aside from the negative price and so on, which I think was an aberration, this market, for the most part, operated in a way that it needed to through a pretty serious crisis.
We have a question from Scott from Kador Matar in New York, who I actually know. Hi, Kador. Thanks so much for joining us. I lost it. What's Scott's view on continued efficiency gains in shale? How much more can be achieved, and have service costs bottomed out?
Yeah, that's a very good question, Annmarie, from your participant. Service costs are down close to 20% going into 2021. If oil price stays where it is and the current rig count stays where it is, I see us getting another 5 to 10%, getting up close to 30%. In regard to efficiency gains at Pioneer, we are setting records as we speak. We just drilled our first well in 8 days. Basically 18,000 foot from vertical plus horizontal. Historically, they take about 16 to 20 days. So we're starting to see the efficiency gains both on completions and on drilling that we started over the last several years. They're still happening. I sort of say we're in the 6th inning on drilling and completion efficiencies. When you look at type curves, and this has been pretty well published already, the type curves, which is the producing characteristics of a typical horizontal well, have pretty much already peaked in the Permian Basin. When you looked at operator by operator, each of those type curves, the producing curve, we're not making better wells. But we are drilling these wells cheaper, which means we'll deliver the same reserves or the same production at much less cost. So I'm optimistic on that level.
Scott, I also want to ask you, because we were just talking about OPEC with Ben. President Trump, during the last historic deal, got on the phone. He was calling the crown prince. He had this call to Putin. You were one of these CEOs that thought that the Texas Railroad Commission should prorate their production. Where do you see the U.S. playing in this field with the cartel?
The primary reason we led an effort to talk with the Texas Railroad Commission was I knew that U.S. shale, we've added 8 million barrels a day over the last, we've upset OPEC, we've upset Russia and OPEC plus, adding 8 million barrels a day. And that 8 million barrels a day could have gone even much higher. But there was a change in the mindset of the shareholder base. Obviously, I said before, so that was going to slow down. We were hoping to participate with Texas Railroad Commission if they led an effort to try to encourage other states and other countries around the world. So I think the president had a chance. He did an historic agreement by putting Russia and Saudi back together. I think it saved the industry. The industry would still be at $20 oil a day, in my opinion, if he hadn't made those phone calls. And they had this historic agreement. And so I think it's best to keep it around 40. And as Ben says, let's keep it at 40. Let's let demand come back. And then eventually the world's going to need more oil, and it's going to eventually move up toward 50 over the next 12 to 18 months, 24 months. But we tried. We had a lot of opposition, especially from the major oil companies and a few large independents. People do not want the government in your business. But as you see what I said earlier, we had U.S. producers shut in for 1 month. Now they're bringing all their oil. So we wanted something along with the OPEC lines. If we could have got 1 million barrels a day out of Texas and another 400,000 or 500,000 barrels a day out of other states and done it for 3 or 4 months, I think we would have driven down the storage issues much quicker. And now we're just going to bounce along. We're going to get the oil out of the tankers. We're going to get people bringing their oil back. And so we're going to fluctuate in this $35 to $40 range, in my opinion, for several months.
Okay, I just have one final question for both of you. And it's a question we asked the poll. How high will crude prices go this year? Like, what's the highest we could hit this year? Not where you think is the best for stabilization, but the highest price we'll hit this year. Ben, do you want to start?
Yeah, sure. I mean, I think I've mentioned, I think this is a pretty sensible price for crude oil at the moment. In fact, probably a little higher than it needs to be. There's no reason it can't actually continue higher. We're probably going to get a sensible agreement out of OPEC. The market will take that well. But it's a little bit like equities at the moment. There's a great deal of exuberance around the place that is not necessarily based on the economic facts. And I think we can end up with a higher oil price than the fundamental market needs, simply because of the investor community who's coming into commodities. I would be incredibly surprised if Brent traded $50 this year, and I would be surprised if it traded more than $4 or $5 higher than where we are now, because I don't think the market needs it. Scott's outlined what happens at this price set. You know, producers start producing too much, we don't really need the oil, and so on. So I see a much more stable market, stable into year end. I share his view that it can trade into $50 in 12 months' time, and we'll have a healthier market as we all get back out of this lockdown and so on. But not much higher than here is what it needs to do. So not higher than 45 for Brent. Let's say that.
Okay, Scott?
Yes, Annmarie, I'm along Ben's views also. I see it could easily move up $5. I think OPEC, I think they'll extend 30 days. They're 9.7. I don't know what Saudi's going to do on their extra 1.2 million, whether or not they'll bring that back on the market above 9.7, but I hope they extend for at least 30 days. It's important to get compliance from the other 4 countries that have been listed in the media that are non-compliant. That's very, very important. If they don't, then we're going to have another price war. And so the U.S. producers are helping on its own by reducing production, reducing budgets. That will have a major effect on U.S. declines over the next 12 to 18 months.
Wow, 35% of the audience actually thinks 50. So I think you guys are a little bit more bearish than the audience. But thank you so much for joining me from Switzerland and from Texas, the Trafigura co-head of oil trading, Ben Luckock, and of course, Scott Sheffield, the CEO of Pioneer. Seriously, thank you both for joining us. This was a really interesting conversation and so timely as we have the OPEC Plus ministers about to meet. We'll be waiting that decision. So our next panel is with our experts in-house here at Bloomberg News. We have the executive editor of Energy and Commodities, Will Kennedy, and also from our BNEF team, we have Ashish Sethia, who is actually originally based in Singapore, but he got stuck through the pandemic in India. So thank you so much for joining us. We're really global, and Will joins us from London. Before we start, let's quickly do an audience poll. Our last one is, when can we expect to see oil demand peak? We've talked a lot about this. We've already seen the peak, which we've heard potentially the BP and Shell CEO have spoken about that. Or is it going to be a little bit later? Will, I want to quickly get to you because I haven't been checking the news for the past hour. Where are we with OPEC? Did they decide on a meeting today? Are they meeting this weekend, next week? And have they been able to get some of the cheaters on board?
It's still not clear when they're actually going to meet. I think in many respects we've been reporting the meeting all week. I think what they're trying to do is forge a consensus and then have a very quick meeting to rubber stamp it. As you said earlier, OPEC meetings have changed. We don't all have to gather in Vienna. It can just be done quickly by video. So they're trying to get there. So what we understand is, yes, as you say, people refusing to comply with their quotas has been an issue. They've talked to Angola and Kazakhstan and Nigeria, and we understand that those countries are broadly on board with better compliance. The sticking point seems to be Iraq, a country that has caused OPEC a degree of problems over the last few years, because it's now the second biggest producer in the cartel, in OPEC rather than OPEC plus, behind Saudi Arabia, but has historically not wished to comply and thinks that it needs special dispensation because of its history. Saudi Arabia refutes that. They want Iraq to play their part, so they're putting a lot of pressure on them. So now we're waiting for the Iraqis to say, yes, we will meet our targets, we will comply. And if that happens, I think we'll get the kind of deal that Scott and Ben were discussing with you, where they extend the current cuts for a month and come back and see where the market is later in the summer.
Ashish, you're with BNEF and you're the head of the research for Asia Pacific. You really have a good grasp on the numbers. As we wait this OPEC plus meeting, what are you seeing on the supply side?
So I think we are very, very carefully watching the US supply stack in particular. And I think we heard from the previous panel that prices need to be at a certain level to have sustainable level of drilling to bring the supply to a sustainable level in the long term. However, when prices were languishing below $20 a barrel, we observed that almost 15 US producers said that they would shut in production worth 750,000 barrels a day. That's a fair bit of reduction. And as prices have come back about $35 a barrel, some of that supply is potentially coming back. But we need essentially $45 to $50 per barrel, as I think the previous panel agreed and said, for US supply to be at a sustainably high level and meet demand.
For our question to the audience at when we would see peak oil demand, pretty much everyone says it's going to be between now and the next 10 years if we haven't seen it already. Will, what do you make of this? I know Bernard Looney said potentially we've already saw it. I mean, will the world actually get back to 100 million barrels a day?
Look, I think Fatih made a very important comment when you spoke to the IEA executive director, which is to say the real thing that we need to understand is policy. And what governments are going to do in terms of pushing the energy transformation, in terms of taxes on carbon and fossil fuels. And I think that will really make a huge difference. I mean, if we see governments, and we're seeing some signs of this in Europe, really push stimulus that is green and look to push things like electric vehicles as we come out. The other key thing that we don't really know and will depend on all sorts of things like vaccines is how the economy is going to perform in the next 5 years. And if the economic crisis really lasts and the recovery is sluggish and people don't go back on aeroplanes and people don't need as many trucks, etc., then the longer it takes to regain oil demand and get back towards $100 a barrel, the further towards the energy transition we may be, and the harder it will be to get back all of those barrels. So it's very early to say, and I think there are two things that really matter: the strength of the recovery and the policy direction in key consuming countries.
If that becomes the outlook, though, for the market, what does that mean for the industry? I mean, that signals to me no investment and investors just running away.
Look, I mean, as Ben said, the eventual price of oil needs to be the marginal cost of supply. And in shale, you've got a very flexible source of oil that can ramp up and ramp down very quickly. I mean, the oil industry's trains. In the past, oil projects used to be on a 20-year cycle, cost many billions of dollars. That's not true now. If we need more oil, shale can supply more oil. So as long as that industry is still there, and you heard Scott Sheffield describe how it's getting more efficient and still trying to drive down costs, then it will respond to the demand picture. I think the real issue comes for some of those people who are in. How do you make that decision with the current level of uncertainty? And I suspect that's very hard for big companies.
Ashish, what do you make of this? What do you make of the industry at the current moment and the outlook for the main oil companies?
As well, it doesn't really get talked about that much. But if you looked at downstream industry, the industry is trying to expand capacity by roughly 10% in the next 5 years. A lot of these refineries are coming up in Asia Pacific, Middle East, and Africa. And a lot of these are being built by the national oil and gas companies, not really by the super majors as we know them. And a lot of these projects are expensive and complex projects. These are integrated refinings and petrochemical complexes, which can produce all kinds of fuels as well as chemicals. And this investment has largely been made on the assumption that aviation and jet fuel demand will continue to rise, commercial transport demand will continue to rise, as well as chemicals will be a huge driver for demand growth. And as I think Well was mentioning earlier, it is probably too early to tell what the longer term impact of COVID-19 would be on some of these sectors. We are seeing how hard aviation has been hit, particularly international air travel. Domestic air travel is coming back online slowly and steadily as lockdowns are being eased, but international air travel might take quarters and quarters to recover to the original levels, and growth will only be thereafter.
And Ashish, where does Bloomberg New Energy stand with peak oil demand? I mean, we had a number of participants say it's already here, but mostly people think 2030s, 2040s.
I'm slightly more optimistic this side of 2030, assuming we get a drag and the pandemic doesn't last very, very long. But I would say it would not be unfair to assume that we see peak oil somewhere in the 2030s. And apart from what we talked about in terms of aviations and chemicals, electric vehicle is a huge part of the equation. And we at Bloomberg NEF believe that there'll be roughly 500 million electric vehicles or cars on the road by 2040 out of the 1.6 billion overall cars on the road in that year. So demand for passenger road fuel would potentially peak in the early 2030s, and hence demand for overall road fuels would peak somewhere in 2030s. And that's a huge part of the equation, even after commercial fuel demand would potentially increase. So that, I think, gives us a sense that somewhere in the 2030s, you might see peak oil demand.
And we've done so much on oil, but natural gas may be the next commodity to go zero. Ashish, do you have an outlook on the natural gas market?
So I would say that natural gas prices going sub-zero or very close to zero, I would not anticipate that to happen. I think it's a little bit unlikely, simply because natural gas probably should be more thought of as a market like Brent, because you have the LNG market to ship around supply anywhere in the world. Obviously, prices are very, very low right now, and I would anticipate actually that once the lockdowns are eased, you would see significant demand recovery in natural gas, because countries are still trying to move away from coal. They're trying to clean up the air, and they're trying to decarbonize their energy sector. So essentially, low prices, very high amount of supply that's come on in the last 3-4 years, and a rebalancing of the market with lockdowns being eased should mean demand should potentially come back this year sometime, probably Q3, Q4.
The other thing I was looking at, I know because Bloomberg wrote this story about natural gas going to zero, but also, Will, we were speaking earlier about diesels at this all-time low. And yet people thought that with COVID-19, there'll be more and more cars on the road. But diesel, is it just flatlining now? Is this, the peak we might see for the moment while cities are still in lockdown for diesel and gasoline?
Well, I think you have to draw a distinction between gasoline and diesel. We've seen a very good rebound in gasoline demand, and gasoline demand is running ahead probably of the broader economic recovery and the recovery from the worst of the COVID crisis. And that's because people like driving. Driving is a socially distant form of transport. So if you're on the subway in New York or on the tube in London, if you're on a bus, you feel exposed. If you're on your own in a car, the risk of catching the disease is very low. So people are really driving, and we see all sorts of data around the world compiled in part by Ashish's colleagues at BNEF about how traffic is running far, far ahead of people going back onto subways. Now, diesel is a slightly different product. Diesel is really driven by the broader global economy. It's driven by trucks and factories. And it was interesting to see this data from the US yesterday that diesel demand remains at the lowest in 2 decades. I think that's a sign just how far the recovery in oil has to run in the US and the weakness of the economy. So you've got a tale of two products here. One which is to do with consumers and their safety, and another which is to do with weakness in the broader economy. Jet fuel, and they're not producing any jet fuel. So one of the things that they can do is just tweak their refineries to produce less jet fuel and more diesel, and they can also, in some cases, reprocess as jet fuel into diesel. And those supply things are driving the oversupply, and that's coming across weak demand. So we do see diesel as the weak part of the global oil complex.
Do either of you have a good sense on when you think, I mean, this is, I think, difficult for everyone, when we will actually see the airline industry start to rebound? Are any companies starting to say when they think they'll likely see it? I know Fitch was saying 2026. Ashish, do you have a read on that?
So I would say, to get to the current levels would take some time. But the indicators that we're watching on the market is particularly domestic air travel is starting to come back slowly and steadily. In China, actually, we are already at roughly 50% or thereabouts of domestic flights taking off compared to the pre-COVID levels. In the US, Europe, and other parts of Asia, obviously, we're not anywhere close to 50%. But as the lockdown eases out, I think domestic travel will start increasing. As I said earlier, international travel, very difficult to predict. The concept of flight bubbles has just started to sink in a lot of people, which means that there are very specific routes with bilateral agreements between countries or cities to allow international air travel with lots of restrictions of sometimes passengers even being asked to do pre-test, for example, and prove that they, are not contagious at the moment. So this is a very evolving situation and completely depends, I think, on how comfortable governments around the world are with the pandemic situation and, how quick we actually get to a drug.
Will, are you hearing more flights over London recently at all?
I can actually see the Heathrow flight path from the front of my house, so I have a pretty good real-time view. A few more, but it's interesting that a lot of those flights are DHL planes, so I think because there's a lot of capacity there. You're starting to see some Emirates planes. I know that they've started flying back into London again. So slowly, perhaps, although that's an example. Of course, in the UK, we have this plan for a 14-day quarantine, so people are very concerned about what that might mean for people in and out of Heathrow. So I think maybe signs of a slight rebound, but still clearly a very long way to go.
Yeah, I need to learn more about that 14-day quarantine, because when I finally do go home to London, I think I'm going to have to go through with that. My final question to both of you, I know you guys just study the market. You're not going to make a judgment on it, but if you had to, where do you think we'll see Brent trade at the end of the year this year? Ashish, you can go first. I think Will's going to be upset with my cheeky question.
I would say, WTI at 45, Brent at 50, something I would believe could happen this year. It might not last for a very long period of time if the demand recovery is not strong enough, but I think we could get there at some point this year.
Will?
You've reminded me, Annmarie, that the last time we did one of these exercises, I took a very bearish view. So, I might just try and prick the consensus a bit. Everyone's very focused on this 45 range. I mean, there's a there's a lot of risk out there. We do not know what's going to happen to the virus as we get back towards the Northern Hemisphere winter. That could really set back the economic recovery. We don't know how stable the OPEC alliance is. I mean, clearly we're seeing some turbulence this week. So while I broadly agree with the comments that Ben made on the base case, I do think there are risks on the downside. So, I will just say I think we'll end up below 40.
If I could just do one quick bonus one, because we are really waiting for any news out of OPEC. If we do get 50, 60, 70s, oh my God, maybe the next year or two, Will, do you see a price war happening again between Russia and Saudi Arabia? And actually, we just have some headlines now on this. Iraq to tell OPEC Plus it will fully implement oil cuts by end of July. And it acknowledges that it has yet to achieve its OPEC Plus output quota. And it tells OPEC Plus that Kurdistan, other issues are slowing oil cuts. Will, does this say to you that they'll likely have a deal very soon?
In the right direction. It seems hard to believe that collectively the group would allow Iraq to scupper the whole thing. So probably. I mean, to answer your question about the would not want to go through the experience again, I think they probably feel vindicated in that at the end of the day, everyone's back around the table, and the Russians are making a bigger commitment to the group than they've ever made before. I think as long as Russia is willing to do that and sees the benefit, and I think presumably sort of probably around 15 or lower on renewables, closer to 40 today. That's a pretty good return for an output cut of maybe 15%. So I think that I think for the time being, no one's got any appetite to go back to the price war.
Okay, I like that. Ashish, since we have these new headlines, what do you think? Iraq tells OPEC Plus it will fully implement their cuts by the end of July. I mean, do you expect we're going to have a deal now?
I would be optimistic on a deal. I would be slightly pessimistic on long-term compliance.
Optimistic on a deal, pessimistic on compliance. I think that's a very good way of putting it. Okay, with that, we are finished. Thank you so much, both of you, for joining me. That's our executive editor of Commodities and Energy, Will Kennedy. Also, our head of Asia Pacific research from Bloomberg, BNF, Ashish Sethia. Okay, thank you all so much for joining us and for participating in this energy event, Powering Forward, Crude Awakening. Any more questions, put them all on Twitter. And hope you're safe wherever you are. We had a lot of viewers from Lagos, Toronto, New York. So thank you all for tuning in.